So many tech companies today are sitting near record highs. Apple ended Friday just under $180, an all-time high, nearing a $3 trillion market cap, and has a forward PE ratio over 30. It's hitting 20% over my calculation of a fair value, and that's with extremely aggressive growth estimates. Microsoft is sitting at over a $2.5 trillion market cap and about 30% overvalued with some aggressive estimates. Google and Tesla have both been on tears this year, and with so many tech companies having such a fantastic year, it may leave you wondering, where do we find value in this sector? So let's not waste any more time before taking a look into 3 cheap technology stocks that, on top of being undervalued, also pay you a dividend that'll help you acquire more shares while you're waiting for them to appreciate back to their fair price. But before we get into that, I'd like to ask, if you enjoy the video, be sure to subscribe to the channel and also like the video. It helps get these videos out to a lot more people, and I really appreciate it. Starting off the list today, we have Intel. Intel has fallen out of favor with the market. No amount of good news has been able to get this out of the rut that it's been stuck in. If we look at it over the past year, it is up a whopping 1.6%. And if we come here from the highs where it was trading around $68, we are all the way down to 50. It is down 35% from its highs. I know it's understandable why the market hasn't been kind to Intel. In the past, under CEOs like Bob Swan, Intel has seemed to have lost its way by slowing down innovation, which led to AMD eventually passing them in chip performance, cost, and power usage. With the invention of AMD's Ryzen architecture, Team Red was finally on top. But now with Pat Gelsinger at the helm, things look like they're turning around at Intel. Intel's new Alder Lake chips go toe-to-toe with AMD's top-of-the-line hardware. Intel is finally coming out with discrete graphics cards that seem like they're going to be targeted towards a more moderate price tier, but they're going to have decent performance as well. Construction of new fabs across the US have begun, with plans to spend billions to finish constructing them. To help fund this, they're going to be IPOing Mobileye, which is a subsidiary of Intel, and that's expected to go for a market cap of around $50 billion. And since Intel is going to maintain a majority ownership, we can expect them to raise at the most $25 billion, even though they'll probably get a bit less for it. The CEO, Pat Gelsinger, has set things in motion to turn Intel around and put them back on top of the chip business. Going into the financials of Intel, we can see why there's so many people out there that love the value that this company has. Last year, they generated $77 billion of revenue, and that has been growing at an average of just over 7% year over year since 2016. Their EPS growth has been even more impressive, growing from $2.12 to $4.94 in the last year. One reason for this explosive growth in the EPS is because of the amount of shares that Intel has been buying back. In 2016, there was 4.7 billion shares outstanding, and they've reduced that to 4.1 billion shares outstanding. This is expected to decrease in the future as they are going to start increasing the amount of capital expenditures that they have as they're building things like new fabricators to build more chips in the US. And this is another reason why Intel is being held down in share price right now, because of the CEO's plans to expand Intel's business. To do this, capital expenditure is expected to start growing significantly as construction on the new fabs really ramps up. But if Intel is going to start pulling itself forward again, they're going to need to spend money to expand. Without it, Intel would just continue to decline like they have been. They need to spend more money on research and development. They need to spend money on building the fabricators for chips, because that's a large part of their business. Intel has a decent dividend scorecard, with a starting yield of 2.75%, which is pretty high for the sector. It has a moderate growth rate at just under 6%, and they've been growing it for 7 years. They're only using 26% of their free cash flow to pay the dividend, so it's pretty safe here. Since Intel is going to be moving towards having more capital expenditures, I could see the growth of this slowing down until that turnaround is finished, but starting off with a 2.7% yield isn't bad. Right now, using these numbers for a discounted free cash flow model, I get that the fair value of Intel is around $73, and this is using a required rate of return of about 7.5%. And this is done with pretty conservative estimates for the next few years, so really I think that this number could be even higher, but I wanted to be conservative with this. So I really enjoy buying this company, especially under $50, but if we look here, Intel is just above that. I'm hoping that they come down a little bit more before I start buying more, even though it's still a pretty good price here. Intel is a turnaround story. It's not guaranteed that they're going to be successful, but I believe in them and the CEO enough to have a small position that I'm planning to hold on to for years while I watch this story play out. The CEO thinks that it will take about 5 years to get over their missteps that they've made in the past, and I'm willing to wait through that because I think they can pull through. Next up on the list, we have HP, ticker HPQ. HP is known for 2 things, their printers and their laptops. On top of that, they are also moving into the 3D printing space as they, quote, attempt to disrupt a $500 billion global manufacturing industry. A lot of their growth over the last 2 years has been driven by their consumer business, as people needed printers and computers to work from home. This does present a risk going forward. Is return to work going to provide enough revenue to offset the decline in the consumer business? The CEO believes that demand is going to remain strong as more and more people return to the office, and so far that seems to be true. Between the end of Q3 and Q4, notebook sales still grew by 14%, but we're also seeing growth in desktops and workstations, which grew by 27% and 12% respectively. Jumping over to their financials, we can see that it has not been a smooth ride for HP over the last 5 years. Revenue barely grew between 2018 and 2019, and then there was the decline in 2020. In the last year, however, revenue has really bounced back and is now 12% higher than 2020's revenue. Their EPS has also exploded since last year, growing by 160% year over year. If we look over at HP's website, we can see how they're boasting about their strong focus on returning value back to shareholders. They've generated $11.5 billion of free cash flow between 2017 and 2019. They're growing their dividends per share at least in line with earnings, if not more. And they have a commitment to investment grade ratings and having a strong balance sheet. And we can see this where they have a fairly decent cash to debt ratio where they have about $4.2 billion of cash and about $6.3 billion of debt. Another way that they're returning value to shareholders is through their dividend. They have a starting yield of 2.7%, and they've been growing this dividend by about 10% a year. They still have a low payout ratio of 24%, which means that they still have a lot of room to grow, and they've been growing it for 11 years. Using these numbers for a discounted cash flow model, I get that their fair value is around $43, which is about 20% higher than the current share price. HP is by no means the perfect investment. They've had trouble with revenue growth in the past, they'll have tough comparisons for next year, and they're working on breaking into another industry with 3D printing. But they are priced at a nice discount to what I think their fair value is, so it's definitely worth a deeper look if you're interested in the company and the business that they have. And last but not least, Dolby Laboratories. Dolby creates audio and imaging technologies. They have Dolby Vision to provide high-quality imaging for computers, TVs, and anything else you want to watch video on. They recently signed a partnership with Vimeo to support Dolby Vision playback. Microsoft Surface Pro and Surface Studio both launched with Dolby Vision. Through Dolby Atmos, they have new deals with Mercedes-Benz for their sound system. MGM Resorts is also going to be using it for live concerts. In total, 95% of Dolby's revenue comes from their licensing of their technologies, with the remaining 5% coming from products and services. Their audio technology is used across several industries from film to video games to live broadcasting, but Dolby does have their risks, which they've laid out in their 10K, such as trends to stream video instead of watching it through cable, and that's led to lower royalties from their end device products. They also face risk from companies going with other audio and visual providers if Dolby starts to fall behind or they're too expensive or, things like that. Dolby plans to stay ahead of competition by innovating their audio and visual technologies, while also building their strong relationships with content creators, movie producers, game developers, and product manufacturers. Looking into their financials, they have decent revenue growth. Coming out of the pandemic year, revenue grew by 10% and is now slightly above 2019 levels. Looking at their EPS, we can see that they've grown it by about 50% since 2017, and this is without much in terms of share buybacks. The shares outstanding are pretty much the same since then. One thing I did notice is that they have about $1.2 billion of cash, while they only have about $500 million of total liabilities. So if they wanted to, they could pay off all of their liabilities and still have $700 million of cash laying around after that. And if we just look at their total debt, they only have $72 million of debt. So they could easily pay this off and still be completely fine. Dolby's dividend yield isn't nearly as high as the other two, but they make up for that by having a much higher growth rate. It currently has a 12.7% 5-year growth rate, and they've been growing that for 7 years in total. With their low payout ratio of 26.5%, they still have a big margin of safety before it gets to a point where they can't really afford paying that dividend. Looking at their history, we can see that they skipped raising it in 2020, but you can't really fault them for that, and they did just recently raise it again by about 13%. I think Dolby is slightly undervalued. Using these numbers for my discounted cash flow model, I get that they're about 4% undervalued. I would like to see an even bigger pullback. If it would fall another 10% or something, that would be awesome. So that way there could be a decent margin of safety before I really consider buying into Dolby. Right now, I think it is undervalued, I think, but if it was even cheaper, I'd be even happier about it. And those are my 3 tech dividend stocks that look like they might be good buys today. Personally, Intel is at the top of the list for me, and it's going to be one that I'm going to be continuing buying. Are you going to be buying any of these, like Intel, HP, or Dolby? And if there's any others that you think are undervalued, let me know down in the comments below. I'm always looking to find good deals in the market, especially with tech companies, because it seems like those are few and far between right now. But with that, I will go ahead and see you all next week.